All right, good afternoon, everyone. Rich Swerbinski with the Mortgage Collaborative here with the rundown with Rob and Rich, our Friday afternoon wrap up to the week and look at all the latest happenings going on in the mortgage industry. And Rob, as always, good to see you. Where the hell are you this week? I refrained on asking you before we went live because I wanted to be surprised by the answer.
Maybe this is a fake background this week, Rich. I don't know, but it's not. It's actually I was telling Amy earlier, Northern California has three primary grape growing regions: Napa, Sonoma, and Mendocino counties. And Napa and Sonoma counties get a lot of the press, but Mendocino County wineries are some of the best. And I'm actually in Mendocino County. In fact, if I swing the camera over, I am in I stopped because I couldn't get home in time for the call. So I stopped here in a vineyard and I'm not drinking. Rich M, don't worry, I'm not all liquored up yet.
That's impressive. Live from
a good office.
Live from a vineyard and allegedly not coordinated and just random. That is impressive if true. So Rob, good to see you. And this week, special guest, Rob and I like to bring on people that can provide some insight far beyond the limited insight we can provide. And this week, really happy to have the Director of Real Estate Solutions from a great TMC preferred partner, Curinos, Richard Martin. Richard, thanks for joining us this week.
Pleasure to be here. Thanks, Rich. Thanks, Rob. Good to be here.
And Richard, the reason we wanted to have you on this week is Curinos is really the industry's leading provider, data, market insights for decision makers in the mortgage industry to help them understand their performance, manage margins, and such an interesting time right now in the mortgage industry. So much is changing so rapidly and at an uncertain pace to leaders. So really going to be interested to get your insights on some of like the behind the scenes data, analytics, technology of things that are happening, changing right now in the industry, and really appreciate your partnership with TMC. I say it all the time. It's one of the great things about this company and being in this role is we get to see all the different third-party providers to the mortgage industry, the ones that stink, the ones that really truly provide value, and then seeing the members interact with one another and share with one another who they're having great experiences with, companies like Curinos that are helping them operate more profitably, more efficiently. And I just want to really thank you for your guys' partnership. Long time with TMC. You guys came on board back when we were really just hopes and dreams. So
yeah, no, great partnership on our side too. I know we've got the event coming up here in a little over a week. TMC United, we're thrilled to be a part of that again. Looking forward to some in-person interaction feels like the first time in forever. So really looking forward to that event.
Awesome. And as always, welcome interactivity from all of our attendees. I already see some of it in the chat. We'll get to that in a moment. Anything you want us to react to, questions, anything you want to incorporate into the program, please feel free to dump it in the chat or the Q&A, and we'll go ahead and incorporate it into the show. So, Rob, I like to start the show off by trying to confuse you with multi-part questions that are meandering and some interesting stats, this week that were just staggering to me. I'll throw a few at you and ask you to react. Black Knight's most recent report, 9.1 trillion in not just equity, tappable equity for American homeowners. Lending Tree survey, 48% of renters worry that they never will be able to afford a home. And inventory, we've talked on this show and others that, inventory is, we're seeing a little pickup each month. Inventory levels still 53% below where they were 2 years ago. So some pretty staggering numbers for the housing market right now. And with that, I tee it up for you.
Was there a question in there?
No question.
No. All right. So excuse that noise in the background. We have talked about inventory. I'm not going to delve too deeply into that. Although, Rich, I am hearing that the inventory is loosening up a little bit, and at some price, people will move, and at some price, people will want to downsize, and at some price, people will want to sell their home near the city and move to the suburbs or out into the country. And we're seeing that, and I'm hearing that from real estate agents and loan officers that actually some inventory is coming into the market, especially especially at the higher price points, unfortunately, not so much the $150,000 house price point, but when you talk about the appreciation that we've seen, in the last year and a half, who was expecting that in early 2020 to say, oh, rates are going to do this and prices are going to do that? I don't remember any expectations to that that address that really. So we've seen this huge amount of appreciation, and we've talked about what a great year 2020 was for so many lenders and so many originators and just our industry in general, helping millions and millions of homeowners either refinance or purchase a house. Well, 2021 is not chopped liver. I mean, 2021, we hit the ground running in the first quarter, arguably the first half, and we thought rates were going to go up and they haven't gone up. And we thought this and we thought that. And instead, what I'm hearing out there is originators still have very decent pipelines. Loan officers and their teams are still very busy. And yes, the refis have fallen off. If you look at the percentages, refis have fallen off with refi burnout, but purchases have picked up. And so there is this whole thing about inventory coming into the market and the purchase market being okay. But when you talk about tappable inventory, and I made this comment that I think everybody on the phone here is very hesitant about using anyone's house as a piggy bank, but it's going to be very, very tempting. And I think a lot of lenders out there are dusting off their cash out refi programs, their HELOC programs, and so forth, to take advantage of that, to take advantage of a great market. Because like I said, this year is a good year, and it's supposed to continue for a while, which actually leads right into something I was going to ask Rich M., which is when you talk about the data that you're seeing and analyzing and so forth. We haven't. I think Rich S. was going to ask you that, but I'm going to jump ahead here a little bit. How would you tell somebody on the call here? Actually, let me take that back. You're at a bar. Somebody sits down next to you, starts chatting. They say, Rich, what do you do and what does your company do? What is the bar speech? What is the elevator speech about the company?
Yeah, no, great question. And I think too, as part of our rebranding, so Curinos now, Legacy Inform and Avantis, right? Recent merger for the two. But I mean, Curinos, our mantra is navigate today, anticipate tomorrow, right? It is preparing you for the future. So what we collect, the data we collect, how does it address the industry challenges today? How does it, put us in a better position to prepare for the industry challenges tomorrow? And so that's a big thing for us. And, the data that we collect, I know this is kind of more focused on mortgage home equity. I mean, you think of the development of lending, the fintech experience, the digital journey we all hear about, the digital transformation. There's limitless options for consumers, right? It's now this unsecured world, the buy now, pay later, that's competing and I think cannibalizing a little bit of home equity. And so we offer a view into all of that. So when we go to an institution, whether it be a bank, whether it be an independent mortgage banker, we talk about that. Your consumers have choices in what type of lending they want, whatever they prefer, whatever fits their situation. And we have analytics around that. So we've got a really holistic view, no matter if that's auto, if it's mortgage, home equity, like I was talking about. We're really trying to position ourselves as lending changes, as it evolves, as that customer journey experience changes, whether it's quantitative in a lot of the data we have, or it's qualitative. We've got a very large omni-channel experience group that does a ton of digital journey customer experience, right? Or even so far as, why did you choose the mortgage lender you chose, right? What was different about that experience? Is it they were servicing my loan, right? That could be a common response to that question. Or I've known this loan officer for 20 years, they're a good friend of mine. But really to understand and get into that borrower decision process. And so for us, it's aggregating that data, both quantitative, qualitative. Like I said, the big key is positioning banks, positioning institutions, preparing kind of for what's ahead, right? Understanding, we get that question all the time now, especially from the banks. What's that digital journey? We all know it's an experience, right? What can you share? What do you collect? And so we're really just trying to hone in that and hopefully, be on the right side of it as consumer preferences change and shift. Our data will hopefully be telling of, as we see that shift, right? What's that narrative we're seeing? What can we share anecdotally?
So I am a self-professed Luddite when it comes to technology and data and so forth. And obviously, there's the saying that you can't manage what you can't measure. The data that you collect, is it through surveys of borrowers, realtors? Is it HMDA data? Is it like pipeline hedging company data? I mean, where does the data come from that you use?
Yes, and that's a great question. I think that's one of the strengths and kind of the beauties of our platform. So it's real time. So it's company sourced. So it's kind of two parts. So we get rate sheet data, right, or go to market data. That's just what you think of, Rob, as a traditional rate sheet at any lending institution, the rates that go out every morning that consumers see. We obviously know there's a degree of price discretion with that pricing. We'll talk about that maybe a little bit later. So that's one side of the house. And then we also on a weekly basis get actual transactional data. So that's the company's applications, that's the company's locks, that's the company's funded transactions. And so we're getting that weekly. So, when we say it's real time, it's through the prior Sunday. So it's about as real time as you can get. And we get to see end to end. So that's the value in it, right? It's not, we only capture locks, then we don't see, okay, well, what was pull through, right? We can assess and see, okay, if we want to look from app, we want to look to fund. Hey, what's your conversion rate? What are your cycle times from your app to your lock? What's it from your lock to your fund? What's it in totality from app to fund? So it's an extensive data set, depending on the lending channel. It could be 30 data elements, in retail, where we collect a lot more of our pricing exception data. It's about 62 to 63 data elements, but it's coming over on that weekly cadence. And so it's about as real time as you get. So we often say for clients, hey, I'm thinking about making a price move or a margin adjustment this week. Let's say I made a margin adjustment Tuesday this week. And of course, they're looking at our data to help support that, right? They can make that change Tuesday, and then they come in next week. We load our data typically Tuesday evenings. They can come in late Tuesday, Wednesday and say, okay, let's look at those results, like you said, to measure. Let's measure that price test. Was it successful? Was it not? And then they can be responsive. We always tell our clients it's best to be proactive, not reactive. You can measure that, and that's the beauty of our consortium is you've got a benchmark. So for lenders to say, hey, I made a price change, my volume went up 20%. Well, that sounds great, right? That was a win. Well, what if the market went up 25, right? You don't have that available benchmark. So with our consortium, lenders can see that compare. So to know, okay, maybe the market moved with me, again, the pricing data, you're going to be able to see what lenders are pricing where. The lender data, originations data, it is anonymized in our consortium, but we do break it out kind of based on institution type. Is it a bank? Is it a mortgage banker? For retail, is it centralized? Is it call center, consumer direct lending, or is it kind of a traditional, distributed retail net branch structure? So we give them that ability to see that, and then ultimately we like to say own their success in saying that price test was successful. I outperformed the market by 5%, right? And then they can gain that knowledge and then ultimately scale that to more markets, to more products, help that fuel retention, recruitment, or just achieve strategic objectives.
Wow. The margin, Rich and I often talk about margin compression, and are we in a margin compression environment? And Rich, you could probably answer, or Rich S answer this as well. But Rich M, so if you are looking at margins, for example, about gee, our margins compressing now, is that information that you have that you can help your clients with?
We do. So we take the pricing data. We don't typically get individual loan level margin. We get a level of concession, but we do have a margin management platform that gives us that capability where we can actually take lender margin and perform that analysis, or with how our data is ingested. We have direct database connection where you could actually just connect in, kind of think through like a SQL connection. So you could have your internal margin reporting and just bring in our data to help kind of supplement that. So there are ways to do it, but yeah, when we're talking to clients, one of the biggest things and exercises we go through is particularly in periods of volatility. that can be interest rates increasing, that can be, directionally both ways, right? You can look at our pricing data, you can look at our originations data, and you can start to pinpoint, okay, bring in my market trading data. Securities have moved 20, 30 seconds. Okay, let's look at what lenders are doing, what lenders are pricing that in, what lenders are leaning into margins so it's not bleeding through your rate sheet. You can start to really get a sense, especially now in the cycle we're entering, and I'm sure into next year, it's margin preservation, right? Where last year you could price wherever you wanted, and you're going to make, record gain on sale numbers. And so that's where we try to pitch is, it's really any market environment for us, whether you're, preserving margin, like will be the more recent trend, or you can make, whatever you really wanted to last year with volume. But yeah, to that, there's a lot of exercises we go through with clients, educating them on, okay, who's moving contrary to the market, and really understand behaviorally. Some lenders just do that. Some lenders find themselves more successful in a decreasing rate environment, right? They're ones that are quick to pass through that market movement, right? And so you can start to see a little bit behaviorally how lenders are kind of responding to that market movement. And then with that, right, do some calculation on just what your margin differential is or your shift in margin, and then start comparing that to what some of those other lenders might be doing that are leaning into price a bit more, hopefully have, offsetting market share to justify a little bit thinner margin, but a lot of those different kind of viewpoints for clients.
So one last question. Does the name come from curiosity?
That was, yes. So the new name Curinos, it is from curiosity. We took customer and kind of curiosity, innovation as well. So innovation is really customer, and then innovation, curiosity, and then the ending, the nos, is us in Spanish. And so we package that together as part of the new brand. But yes, you're one of a handful of people. That was the first reaction of, one, how do I pronounce it? So we sent out a pronunciation key with some of our marketing, but then I think it was also that it sounds a lot like curiosity. So yeah, you're absolutely spot on.
As a quick aside, I know Rich wants to talk about affordable housing and manufactured homes and so forth. So I grew up in the Santa Clara Valley, and my ancestors helped settle the area now known as Cupertino, like Cupid, Cupertino. And they would get very irate when somebody in the area would say Cupertino, near San Jose, Cupertino. No, it's Cupertino, like Cupid, like curious. So anyway, I digress. So Rich S., I wanted to ask you, since I've got the soapbox here a little bit, what are you hearing from the Mortgage Collaborative lender clients about the they've come out with this affordable housing plan, and 100,000 units, and they're going to control all the cities and counties and local municipalities. Are lenders excited, or are they kind of shrugging and saying, well, that doesn't really, we're not involved yet, so let's go about our business?
Yeah, it's kind of like, how our members looked at e-close a few years ago, and non-QM to a certain degree, even still today, like, let me know when there's something tangible here. The proposal that the Biden administration came out with, it was lots of words. It was nothing that seemed to be easily enacted or that would move the needle a lot. And I think the vast majority of them that I've talked to kind of agree with how MBA reacted to the proposal. And that was, this is great. Anything helps. We have a major inventory problem in America with housing, especially lower priced homes. So anything helps, but we're going to need congressional intervention and, law changes or, bills that are put through Congress to truly help the situation. So that was, pretty much everybody I've talked to, that kind of was their reaction. So
yeah, I've heard almost identical thing. Lenders who have tentacles or fingers in with lobbyists or with Washington DC or some kind of political insight will tell you that the focus of Congress and the Senate and the House of Representatives and so forth, it's fine for President Biden to make these speeches, but Congress, I mean, the whole focus is still on the pandemic and some of the measures that have been announced or promoted this week. It's on still immigration and on foreign relations. It's not quite the, if it's not broke, we don't have to fix it kind of mentality with regard to housing. But I think it's somewhat low on the totem pole. Certainly Fannie Mae and Freddie Mac, in terms of talking about them exiting conservatorship, that's vanished from the dialogue out of Washington, D.C. It's not an issue that Congress is addressing at all. Rich M., do you, in your data that you collect and your granularity and so forth, do you look at say the types of properties that lenders are lending on, and do you get that far into the weeds with the data that you collect?
Yeah, so we do. So from a transactional level and like kind of a loan attribute basis, yeah, we have property type. A big one for us and a big win was occupancy. We all know the cap imposed by FHFA. You're able to see your production, benchmark your production to the caps. You're also able to see your rate trends relative. We had lenders pricing weekly, right? Adjusting those levers and price, controlling that volume with the cap. We collect LTV, we collect FICO, we collect DTI. Kind of the credit risk spectrum, if you will, of lending. So lenders, that's been a really big thing now, both in home equity and mortgage. Where's my FICO floor at, right? Maybe a little bit more in the government space. We had some lenders say, hey, we've been hanging out at 620, maybe we should go up to 660. And we can help quantify if there's loss there, right? Like they might feel better from a credit risk perspective, and maybe what they're looking at, from a default end or that or anything on the servicing book. But for us, right, how can we measure that? So yeah, property type is absolutely one. For lenders that maybe want to get into manufactured space, that's a profile of property that we capture.
This is The Rundown with Rob and Rich. I'm Rich Swerbinsky with the Mortgage Collaborative, joined by Rob Krisman, and this week's special guest co-host, the Director of Real Estate Solutions from Curinos, Richard Martin. Richard, I want to dig a little bit more into the home equity issue. I know that is a division you're over at Curinos, and it's a fascinating one to me. One of the things I love about the mortgage industry, more now in this role than as a lender and a leader when it was challenging, and I hear and see this challenge from our lenders on a daily basis, is just the constant change in the mortgage industry, and based on government and regulatory policy, the interest rate climate, other factors with the United States economy as a whole. And what we have right now is we've had Rob touched on it, a record year for mortgage originations in 2020. It's looking like 2021 is going to be the second biggest year ever for mortgage originations. A lot of refis, a lot of people that are locked into 30-year fixed rates in the twos, and we're now, because of home appreciation and other factors, really unprecedented levels of tappable equity. We know Americans can't help themselves from completely leveraging assets, and we're going to see a massive amount of cash out refi and home equity lending in the years to follow that I think lenders are gearing up for right now. Cash out refi is obviously capped at 80%. Conventional home equity lending though. So, not a lot of really great liquid outlets in the secondary market for just like small independent mortgage banker in Ohio or Seattle to originate like standalone HELOCs, right? The depositories are doing a lot of this business. So, would be interested to hear your insight. One, any data that you're seeing yet or already, or trends that you've seen in the past that could be interesting to our listeners related to home equity lending. And then to Richard and Rob, more broadly, just how you see the tapping of equity to play out real world with lenders. Because it's going to be interesting to see how aggressive the banks get. Banks will typically go to 85 or 90 on a HELOC, depending on different factors. I think you're going to have a lot of HELOC demand because people aren't going to want to touch their fixed rates in the twos. And maybe they don't want to spend the whole $100,000 in equity, but they want the first 20 and you're only paying it. There's a lot of advantage to HELOC. So how you see like HELOC lending playing out just as we move forward into 2022 and beyond. Richard, I'll start with you.
Yeah, no, it's a great question. I mean, we commonly, at least going into next year, it's, hey, Rich, what's the outlook for home equity, right? I think there's just a mixed a mixed bag of opinions on it, right? And people really unsure of, okay, I don't think it's a question of if, I think to your point, Rich, it's a question of when. We know rates will eventually go up. We know the Fed's going to begin tapering, whether that's announced, in a week and a half in the September meeting, whether it's announced later, seem to be maybe by end of year, early next. So it's definitely a question of when. I will share with you from the data perspective, a couple of things you touched on, Rich, that I think are valuable. It's new entrants, right? You look at what some of the bigs are doing. It's kind of a hit pause, sort of a wait and see approach to lending. They can certainly serve their customer base through a cash out option in the mortgage. We know cash out rates still remain low. Again, on a historical basis, it's not where we were last year, but it's still competitive. So you've got the new entrants, fintechs being part of that now, some fintechs becoming banks like the SoFis of the world, right? That are starting to wade into it. So I think you've got this dynamic of new entrants. The other piece that's really telling in our data is we look at both line size, right? But then also balance. And I think this is talking a little bit about my earlier comment on the choices that customers have. So 30% of our lines were with a balance of 50 or less, right? So that's a prime target for a cash out transaction. That's a prime target for unsecured lending for a buy now, pay later. So 37% of the lines, 73% of the balances are under 50, right? And so what that's kind of telling you is you've got, if you look back even to some of the bank earnings for Q2, you've got a somewhat cautious consumer, right? Where we feel sort of our hypothesis is home equity is kind of an insurance policy, right? I mean, you saw the huge run up in applications we see in our data. March of 2020, pandemic hits, panic application. We see a little bit of it materialize in bookings, right? Not nearly the amount, but it's really been, on a broader historical basis from at least a booking amount. So what we track, we're really back in like the 2010, 2013 range of where we've seen volume. And we're not where we were in 17, 18, 19, I think is where we start to see things kind of pull down. So it's, I think you're going to see higher line sizes just by way of the appreciation we talked about, right? The 9.1 trillion, I think it was a trillion they just added in Q2 of this year. But it's really that segment that we're seeing some cannibalization in for home equity at 50,000 or less. Cash out looks very attractive. Unsecured looks really attractive. And to your comment earlier, Rich, some people want an unsecured option, right? They don't want to tie up their house as part of it, or people like the shorter duration on those products, fixed payment aspects. So it'll definitely be interesting. I think I agree with you on what we're seeing in the data. We're not seeing HELOC take off just yet. We've had maybe 2 months of a little bit of uptick in overall volume, but certainly not supporting. It seems to just be an overall preference to cash out right now versus the home equity product. So I think a lot of what you touched on is absolutely true. We're just not seeing signs yet of it taking off.
Rob, I watched an incredible bank here in Cleveland, Ohio, National City Bank, 100 years, an amazing bank, did everything the right way, performed great, stock, everything. They got into standalone seconds in 2005. And, we're doing a lot of standalones. That was the big part of their correspondent and wholesale strategy, up to 100, 105 in some cases. And when the meltdown hit, the bank just crumbled overnight. Ended up selling for like $1.30 a share, a bank that was $70, $80 a share to PNC, like almost overnight. I was almost in disbelief. Watch, I banked with National City my whole life. Where I'm going with this is I'm curious to get your thoughts on how you think the depositories will handle second mortgage lending, HELOC lending as we go forward. Certainly we've had year over year, 18, 19% appreciation. We've talked on this show. I don't think you're going to see any kind of correction anytime soon, or if at all. But, when you're a regulated bank, you got to look at things a different way. It's going to be interesting to see their risk level. And what risk that banks are willing to take on HELOCs, what CLTV they're willing to go up to, and also Fannie and Freddie, will they change their stance at all on cash out up to 80%? I think limited cash out, you can go up to 85, I want to say. How do you think that's going to play out?
So once again, Rich, one of these multi-part questions, I barely know where to start. So where should I start? So let's take a step back a little bit. And what the industry has realized with second homes and with non-owner occupied homes is that those products are not Fannie Mae and Freddie Mac's emphasis. Fannie Mae and Freddie Mac's emphasis are to help the financial markets in terms of stability of home financing. And the charters talk about this, that, and the other thing, but the Biden administration has made it clear that their focus is on affordable housing and first-time home buyers. So if you look at Fannie Mae and Freddie Mac, they aren't, I don't see them as being excited to go up the LTV curve or go down the credit curve too much. That said, you have to remember that we're dealing with, for the most part, a different group of borrowers that own homes now than own homes in 2005, 2007, 2008. We have the ability to repay requirements that are in place and hopefully being exercised. And so when you talk to lenders, the credit quality of the borrowers that they've either refinanced or helped purchase homes here in the last few years is head and shoulders above what we were seeing or what they were seeing in 2005, 2007. In addition, the programs are much more conservative. So the foundation that we are dealing with here in terms of where do we go from here, I'd say is much stronger than it was 15 years ago. So that said, what I'm hearing in terms of depository banks, what are they doing? They, of course, are going to try to play to their strengths. The strength of a bank or a credit union, and I know you're dealing with credit unions as well, is they have deposits, they have cross-selling opportunities, so forth. They have a bigger picture of their borrowers, of their clients, but also they have they can offer a wider product set. And so the independent, especially the small independents out there, are going to be, I see it as scrambling a little bit to try to find products to take advantage of this equity that's out there. Or as Rich M mentioned, they're not quite jumping onto the HELOC train yet, but at some point they might. But for right now, I think, it's still a moving target. Independents are independent loan officers are saying, what do we have to take advantage of this? Yeah, my refi business has dried up a little bit. I shouldn't say dried up. It's fallen off a little bit. Purchases have picked up a little bit. But what does my capital markets crew have in terms of products up their sleeve that can help borrowers who call me up tomorrow and say, hey, I hear my house has gone up, $50,000 or $100,000 since when I bought it. And, me and Moon Baby want to buy an RV and tootle around the Western US, or heck, I've got to pay for Tufts University or whatever it might be. We just put in AstroTurf in our yard because of the drought, whatever it might be. They have expenses. So that loan officer wants to be able to help them. If you're working for a credit union or a bank, typically that's an easy choice. But if you're a small independent mortgage bank that doesn't have that kind of product lineup, you're going to be searching for outlets or searching for investors, and hopefully your capital markets team can deliver alternatives. I know Symmetry, for example, has a HELOC product that's out there that has become wildly successful in terms of volume, in terms of what they're seeing and doing. So, and I think once again, Rich, comes back to what Rich M is talking about in terms of being able to mine your data and figure out what kind of clients are you dealing with, what kind of clients came through our doors last week, last month. Rich M, I mean, do you have a lot of repeat business from your existing clients and coming back through and looking at the data and trying to figure out where do we go from here?
Yeah, I mean, I think our kind of headline is well, over 55% repeat clients. I mean, I think to the last point you made, Rob, is, we collect, at least for home equity, it's not just originations, we also collect portfolio. And so, right, portfolio gives a lens into utilization, delinquency, vintage, to really get an understanding of, what you've taken on, how it's performing. But one thing I'd add to that is we sent a poll out. We usually do quarterly polls with each of our clients. And the comment or question you had earlier, Rich, was where are you from a credit box, right, or a buy box perspective? Are you near, are you at pre-pandemic? Are you somewhat near it or feel like you're going to near it in the next few months? And it was about 50-50 roughly. 50 felt that they were already at pre-pandemic credit, buy box. And then probably the other half, I'd say 25% were within 3 months. And then the most conservative kind of cohort group was probably within 6 months. But I think Rob's absolutely right, is our data can help you understand that, right? What's occurring, from an LTV, FICO, DTI risk perspective. And the other piece we do that's helpful in our at least portfolio data, we're seeing lenders start, fee waivers, annual fee waivers. That is kind of a more common practice. We can measure that response and volume, and just trying to get creative, right, with their marketing. We're seeing, when we talked about the new entrants earlier, we're seeing the Figures of the world and others. We can get you closed in 5 days, right? And so, we measure cycle time as well as part of our data set, understanding where you're competing, where you're losing out. I mean, that cycle time's a big one. And, 5 days, a traditional bank, I don't think is going to beat that, right? So to Rob's point, I think it's understanding that landscape, and then really devising a strategy to be successful. And a lot of those decisions, or those strategies, being data driven. I think that's where we come in with a lot of that.
This is the Rundown with Rob and Rich. I'm Rich Swerbinsky with the Mortgage Collaborative, joined as always by Rob Krisman, and this week by the Director of Real Estate Solutions for Curinos, Richard Martin. Richard, getting back into margins and pricing pressure, the typical TMC member last spring or 2 springs ago was like, oh my God, I could be losing my company. The fall of last year, I can't believe how much money I'm making. I cannot believe the margins on this volume. And how quick it's coming in. Spring of this past year, it was kind of like, margins are way better than I thought they would be still at this point. But now, especially this last month, we're starting to hear from the members that they're really starting to feel the squeeze. As refis are starting to fall off, it just feels like the refi train is kind of running out of steam. And so many people have already taken advantage, and, the purchases are improving, but not to the level that refis are falling off. And they're just having to sharpen the pricing pencil more. The smartest TMC members I talk to are batting down the hatches for a climate that they feel could be very much like the one of the winter of 18 and 19, where margins were non-existent. Lenders were writing loans at losses just to keep pipelines full. So a couple questions for you here. Any data off the top of your head from that dreaded winter of a few years ago that I think was the worst I've ever seen, in terms of just margin compression? And then 2, is your data backing up right now what we're hearing from the TMC members as it relates to recent margin compression?
I think it does. One of the things we track, in addition to just rate sheet pricing or transactional rate right on the origination data set, is around concession, right? Concession usage, concession amount. I mean, probably not surprising to your members, Rich, or even to Rob. We saw a theme last year with refi where banks struggled from a cycle time and operational perspective. And we saw independents take market share, just talking kind of traditional conventional space, traditional refinance. We've seen an interesting change coming into 2021 where we see a normalization in turn times. Banks now have come down in terms of turn times closer to that independent subset. And we're starting to see through the price concession data, banks taking less concession because they've already improved their pricing position, right? They've improved their go-to-market price, right? Less of the discretion. If you have a more aggressive market price, ideally, you would think you would take less concession on the transaction. So we're starting to see a little bit of reversal now where we're seeing, I think, banks get a bit more aggressive, sharpen the pencils. Again, I don't know if it's a long-term strategy because the data, is only kind of looking at the last maybe month or two in terms of what we're seeing on the concession side, but we're definitely seeing some folks lean into price. They can gauge if they're getting resulting market share, but I think some doing that largely as a response to could be where they're at with capacity. Everybody that knows the hiring that occurred last year, we need volume to just funnel the machine, or simply just trying to make a grab at market share. And so the data seems to be suggesting, that concession, just that go-to-market price improving, so lower margin or margin compression you're talking about. I think the big unknown is whether we see that persist, right? Outside of just what the market's going to be doing from, a primary, secondary spread perspective. We still know that's inflated kind of on the historical basis. but what the market's willing to give, what can I do from a price strategy perspective?
So Rich M, you should know that Rich S is very good at looking at trends way in advance of when they actually happen. And so we're talking about margins here. And Rich, you're talking about the winter of 18 and 19. I keep flashing on, like thinking about like Leonardo DiCaprio in The Revenant, like people, like lenders walking around with big, bearskin coats or something, dealing with the elements. I don't think it'll be that bad. You're right, it hasn't happened yet. That's not to say it won't happen, but the margin adjustments that I'm hearing about are definitely very channel oriented. Wholesale different than correspondent, different than retail, and correspondent has always had traditionally thin margins. Wholesale not quite so thin. The retail margins tend to be a little fatter, especially with banks and credit unions and so forth. But yeah, it'll come eventually. As we talked about earlier, the refi business has slowed a little bit, but it hasn't fallen off a cliff like some people thought it would. And it seems like there's always something that saves this industry. I'm hearing some estimates that rates are actually, the 10-year is going to go below 1% by Thanksgiving or Christmas. I don't know if I necessarily agree with that, especially if the Fed starts scaling back its asset purchases. But nonetheless, we continue to be in a very good rate environment, and lenders are doing just fine. I don't think I don't hear, to your point, Rich S, I don't hear anybody talking about thinking about going out of business or why am I doing this kind of stuff. I mean, they're having another great year, and good for them.
Yeah, not that. It's just that I think the way they feel is like that there is always going to be elevated demand to supply, at least for like the next 3 years, just in housing, that there's, from a supply side, inventories can go up a little bit, but that the demand and the suppressed demand is just going to outweigh that. And that you're just going to have this long cycle of low inventory and very competitive market with the obviously falling off refi. So,
but somebody's got to help borrowers get loans. Somebody out there has to do it, right?
Yeah. So
I think some of it's due just that velocity, right? You look at margin gain on sale numbers Q4 to Q1 to Q2. I mean, some people, they're half of what they were in Q4, right? I think part of that just how quickly, right, it changed. And then of course, how is it going to continue on that trajectory? Will it normalize for a period? I think Rob's spot on. It's not seeing it. And again, we're seeing a little bit of it in our data just by that concession usage metric, but I don't think enough to where people, it's not the liquidity crunch, of last year where people are shutting off product lines, concerned they can't even, they're getting margin calls, the servicing remittance piece. It's not to that level of panacea, certainly.
We're just about out of time, but one thing I gotta get your perspective on, Richard, the number, if not the number one thing, one of the top things we hear from members, especially our independent mortgage banker members, is I need good jumbo outlets. It's just the perpetual, we joke about it, our staff, because it's like the number one inquiry we get, general inquiry. The jumbo markets in general, I know you guys provide and collect some pretty unique insight on the jumbo securitization markets. Would love to hear any insight you have there, what you're seeing, and maybe how you see that market playing out as we move into the future here.
Yeah, I mean, certainly for last quarter, I mean, you look at the numbers just from an issuance perspective, I think that second quarter this year was the best quarter since pre-financial crisis. I think it was 2007. And we're hearing a lot of lenders talk to us about their jumbo position. The focus is on fixed. We know ARMs has certainly become attractive when it makes sense. But yeah, it's largely, do I have jumbo outlets? How am I positioned competitively? And so our data gives you, ability to see something like interest only, right? Is it truly a niche product right now? How many lenders are we seeing lending in that space? What are the characteristics of those loans? The interest rates being offered, the loan amounts being targeted. So yeah, a lot of our data and concern, as you mentioned, Rich, from the client side is, where do we need to be positioned for jumbo? From a rate perspective, I'll share an interesting statistic. We saw with 2020 last year, historically jumbo rates inside of conforming. So typically maybe 40, 45 basis points in rate inside. We saw that normalize certainly kind of the second half of last year, got it to where almost they were actually at parity. We saw conforming come in. I think some of that was just the pause in the securitization market, concern about demand, concern about risk. And then we've seen to the start of this year, really in the last 3 months, we've started to see that rate trend continue, right? Go back to jumbo being inside of conforming. On an overall percentage basis, we're seeing our volume a few percentage points higher in the last 3 months versus first 6 months of this year. More volumes getting done. I mean, higher home prices, I think, naturally. The big thing for me with jumbo will be interesting is, what Rob alluded to earlier, what the agencies are going to buy if they make any, material changes to their buy box. If, the loan limits, what are those going to look like? I mean, home prices are up 17, 18%. If you look at FHFA index, Case-Shiller, they typically raise conforming limits, 5-7% a year, right? So what does that look like? And then what's that opportunity for jumbo? We know, the non-owner stuff's being stuffed in there. I think there's going to be a lot of opportunity there, not even touching on non-QM. So, right, our data is just giving, I think, a lens into that market. Where do I need to be positioned from a rate perspective?
That's a great point. The agency conforming loan limit. It's about this time of year, right? I want to say it's not later. It's the end of the year, right?
Thanksgiving.
October, November.
Thanksgiving.
Okay, so it'd be interesting to see what they do there because homes have obviously appreciated and would certainly justify it based on that. So, well, before we wrap up for the week, and I want to get your guys what we got going on this weekend. One plug, we're starting a new show on Monday mornings at 11 a.m. Eastern called Monday Mortgage Quarterback. It's going to be pretty cool. We're picking the top 3 NFL games from each Sunday. This week, Cleveland, Kansas City, also Green Bay, New Orleans, and also Pittsburgh and Buffalo. And then we're bringing on lender members from each of those 6 cities for a little banter about the game that happened the previous day, but also to get insight into their local housing markets. Many more of our lenders with national strategies now, even small independent mortgage bankers that are thinking national as opposed to just, I'm an Ohio lender. So something we're going to do to help provide a little insight as to local housing markets and end this kind of a tradition now, the weekend plans. Richard, are you an Oregon Ducks fan? They play my Buckeyes tomorrow at noon.
I'm born and raised in Idaho, so I guess a Boise State fan through childhood, but it's Washington State, University of Washington up here. So by marriage, I'm a Wazoo fan. So we'll be rooting for the Cougs around here.
Any interesting weekend plans of notes up in the Pacific Northwest?
I've got a concert. I'm going to see John Legend this evening. He's at one of the wineries in the area, so it'll be my first concert in years. But yeah, looking to get outside, enjoy some music.
It's not at the winery that Rob's broadcasting.
I was going to say, I don't think it's ours looks a little different, but Rob, you're certainly more than welcome.
Rob, weekend plans, stomping grapes. What do you got going on this weekend?
I may have a glass of wine for lunch today. I am going to eat lunch besides what I had before the show here. Play some hoops and try to stay out of the smoke in California.
Yeah, the wildfires out there. So yeah, I've Buckeyes, Ducks at noon Eastern tomorrow, and then Browns Chiefs Sunday. So I'm ready for some football. Good start to the NFL season last night, and we'll talk about it a little more as we get into Monday Mortgage Quarterback. I dropped a link in the chat. Anybody wants to register for that show, even if you can't make it live, you get the recording and the podcast sent to you. So, well, Richard, thank you very much for joining us this week. Greatly.
Yes, thank you. Thank you very much.
Your insight into the mortgage market, and appreciate the partnership with Curinos. Anybody that wants more information on Curinos, the TMC website, on our preferred partner page, there's a bunch of information about them. You can obviously reach out to me or just Google Curinos. We'll give you, I can get you Richard's contact information, and we have a slew of members that are using you guys for data and analytics, really helping them price, understand cycle times, margins, all that good stuff, vital information for business owners that has been very valuable. So thank you, Richard.
Yeah, pleasure, guys. Appreciate this. This was a great conversation. Appreciate you having me on.
And Rob, we're off next week. And this show has gone weekly now, but we're off next week because we'll both be traveling out to California. I guess you won't, you might be traveling, but for TMC Summer Conference.
Yeah, we'll see each other's ugly mugs in person, Rich.
Right, after all these Zoom
Rich,
calls.
Rich Jess, not Rich M.
I will be there. I will be there as well.
Yeah, so.
All right.
Excellent. Well, and to our attendees, thank you as always for wrapping your week up with us every Friday, except next Friday at 3 p.m. Eastern, the rundown with Rob and Rich. And until 2 weeks from now, have a great few weeks, everyone. And we'll see a lot of you in Terranea live next week. Take care.
All right.
Bye, guys.
Take care, guys.